Welcome back, Focus Learners. Today we're jumping into a highly requested explainer covering the Nepalese energy sector. We're going to do a completely impartial, data-driven due diligence breakdown of Bikash Hydro Power Company Limited. Whether you're actively trading on the Nepal Stock Exchange or you're just, fascinated by how renewable energy economics play out in developing markets, we're going to strip away all the noise. We're looking straight at the hard operational and financial realities of this company.
And really, that brings us to the ultimate question on every investor's mind, right? Is Bikash Hydro Power actually a solid investment? See, when a company makes that huge leap from being a high-risk construction project to a publicly traded operational power producer, the way we judge its value has to completely shift. Today, our focus is entirely on their core asset, the 4.55 megawatt Upper Machakola small hydropower project. We're going to look at what they built, what it actually cost them, and whether the cash it's throwing off today justifies the price tag investors are paying.
Okay, let's dive into our game plan. First, we'll cover the asset and the market. Then, milestones and leadership. Third is financials and credit rating. Fourth, we'll hit risks and mitigations. And finally, valuations and investor takeaways.
All right, part one, the asset and market. Let's look at what they're actually working with.
So, Bikash Hydro Power operates the Upper Machakola small hydropower project. We're talking a 4.55 megawatt capacity, located out in the Darche municipality of the Gorkha district. Now, this is a run-of-river plant based on a Q50 model. Basically, that just means it relies on the natural flow of the river instead of sitting behind some massive, expensive storage dam. It generates an estimated 31.157 gigawatt hours a year. But honestly, the absolute most crucial factor here is their power purchase agreement, or PPA. They hold a 30-year take-or-pay contract with the Nepal Electricity Authority. That's a huge deal. Because of this specific model, the NEA is mathematically obligated to buy the power they generate. Your market demand, it's legally locked in.
But here's the catch. Not all electricity is priced equally. Nepal has this massive surplus of energy during the monsoon season, but they face real deficits when it gets dry. So, to incentivize companies to generate power when the grid actually desperately needs it, the PPA uses a bi-seasonal tariff. In the wet season, they get 4.8 Nepalese rupees per kilowatt hour. But look at that dry season rate. Boom! It jumps up to 8.4 rupees. So why does this matter to us? Well, Bikash Hydropower actually boasts a 39% dry season energy mix. Having a high dry energy ratio like that is an incredibly lucrative revenue generator, and it acts as this massive financial safety net when the total river flow inevitably drops.
Moving on to part two, milestones and leadership.
And this right here brilliantly illustrates one of the absolute most remarkable things about this project. Look, in the hydropower sector, massive delays are just the norm. Land acquisition, environmental red tape, rugged terrain, it usually takes forever. But Bikash got their survey license in the Nepali year 2074, signed the PPA in 2075, and hit their commercial operation date in 2079. Which was February 2023 for those of us on the Gregorian calendar. The big takeaway? They actually finished this project 5 months ahead of schedule. That is practically unheard of. That early completion meant 5 extra months of making money instead of racking up debt, which perfectly set the stage for their successful public listing on the NEPC.
Now, you definitely don't beat a construction schedule by 5 months without some serious talent at the wheel. The board here is this really strategic mix of founders and independent voices. You've got Chairman Kigendra Nupane and Managing Director Krishna Prasad Gamaire providing the operational muscle and the vision. But, and this is absolutely crucial for public investors, you also have Independent Director Uttam Adhikari keeping an eye on compliance, alongside public directors like Dr. Manumaya Bhattare. They ensure that the minority shareholders, basically us, have their interests represented at the very top level of the company.
Let's jump into part three, financials and credit rating. Let's look at the actual numbers.
Okay, so while they did finish early, I have to point out they didn't exactly finish on budget. The project actually took a 37% construction cost overrun, bringing the final bill to around 1,118 million Nepalese rupees. Building in the Gorkha region comes with a lot of logistical nightmares and geological surprises. But despite that hefty extra cost, management kept a surprisingly tight grip on their capital structure. They funded it with a 58-42 debt-to-equity ratio. For a super capital-intensive utility company, keeping debt below 60% while dealing with a cost overrun, that's a really strong sign of financial discipline.
And the broader financial sector totally noticed that discipline. ICRA Nepal just upgraded Bikash Hydro Power's issuer rating from a BB to a BBB-. That officially bumps them up into investment-grade territory, meaning they have a moderate degree of safety when it comes to paying back their debts. This upgrade happened because of that early commissioning, and the fact that once a hydro plant is actually up and running, the profit margins are frankly incredible. In Bikash's case, their operating margins have been hovering around a massive 80%.
And we can see that 80% margin translating into cold, hard cash flow. If we look at their recent unaudited financials, like the Q2 post 2082 snapshot, and that's backed up by recent reports of a 71.08 million rupee net profit in Q3 of fiscal year 83-83, it's super clear the company has successfully flipped the switch. They aren't burning cash on construction anymore, they are actively bringing in positive net earnings. The whole game has shifted from building the machine to managing the cash the machine prints.
But it's not all sunshine. Let's get into part 4, risks and mitigations.
Right now, the single biggest headache for Bikash Hydro is energy evacuation. They have to push all that power they generate through a 22-kilometer, 33-kilovolt alternative transmission line that connects out to the Baseri substation. And this rural line, it trips a lot. Remember how we said this is a run-of-river project? Well, if the grid goes down, the water keeps flowing past the turbine, and it can't be stored. That revenue is just literally washed away forever. Because of these grid bottlenecks, they've only been able to supply about 75% of their cumulative contract energy. Throw in the fact that climate change is messing with monsoon patterns and glacier melts, and yeah, this revenue stream definitely has some real volatility.
So what is management actually doing about these threats? Well, quite a bit actually. First, on the grid issue, the NEA is actively upgrading protection systems, and there's a much more robust 132 kilovolt line proposed for the future. Second, like we talked about earlier, that impressive 39% dry season energy mix mathematically acts as a cushion if they have a bad hydrological year. But third, and I think this is the smartest move, the parent company is building the 4.6 megawatt Super Machakala project literally right next door. By sharing logistics, sharing the workforce, and potentially pooling new transmission infrastructure across the same basin, they are actively driving down the risk and the cost for every single megawatt they produce. Which brings us to the final piece of the puzzle, Part 5. Valuations and investor takeaways.
So, the crucial point boils down to this number right here, 48.24. That has been their approximate price to earnings, or PE ratio, lately. Now, if you're a traditional value investor, seeing a PE near 50 is probably making you raise an eyebrow, right? It tells us that investors are either pricing in some serious future growth, or they're just super willing to pay a massive premium today for the sheer safety of that government-backed, mathematically guaranteed revenue stream.
Let's break down how that actually looks across the other key metrics. With the current market price floating around 503 Nepalese rupees, the price-to-book value sits at 4.59. Earnings per share, pulling from that recent Q3 data, is a solid 10.43. What you really need to understand here is that you're paying a premium for an investment-grade, fully operational asset that literally beat its construction schedule. But, and this is a big but, because they are a brand new listing, there is zero dividend history to rely on yet. You aren't buying a proven track record of fat dividend payouts, you're buying the potential for future yield once they pay down that debt.
Which leaves us to the absolute most important question you need to ask yourself today. When you take those huge operational margins and the strategic expansion right next door, and you weigh them against the lost revenue from that tripping grid and the complete lack of a dividend history, does the current market price actually justify the long-term return for your specific portfolio? The hard numbers are all right here on the table, the asset is flowing, but that final valuation, that is entirely up to you. Thank you so much for joining me on this explainer. I really encourage you to go dig into these financials yourself, keep learning, keep analyzing, and I'll catch you all in the next deep dive.